Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Mark Kenney. Thanks for being on the show again, Mark.
Thanks for having me, Whitney. It's good to see your face.
You as well. And if you are a longtime listener of the show, you have heard Mark and I discuss numerous topics about this industry. He is definitely an expert. We've also had numerous people on who have learned the business from Mark and are achieving massive levels of success. And so I just want to thank Mark again for his time. But just in case you don't know of him, he's a seasoned real estate investor, coach, two-time best-selling author, and founder of Think Multifamily. Mark started his apartment investing career over 20 years ago as a side hustle while working 80-plus hours a week in the corporate world. He has purchased over 8,000 units in just the past few years in 6 different states. So, Mark, thank you again. Grateful to have you back on, just somebody at your level of experience in purchasing, especially in 6 different states as well, and just getting your take on what's happening right now in the market and what you see moving forward. You want to give us any updates on what you all are up to right now, buying, selling, what's happening in the Think multifamily space?
Yeah, absolutely. So, we're actually just closed a deal less than a week ago. So we're in 7 states now, which is great. So we're still active. It was pretty slow there for a couple months. We were, I think some people, in my opinion, were not using that time wisely. That was the best time to start building relationships further because a lot of the brokers and such had a lot more time then. They really did. So people sat around, didn't do much. They kind of wasted some of that opportunity, but that's okay. We were still very active looking at properties. We, as I mentioned, it's closed a deal. We have 4 other deals under contract. So we're definitely active. As far as, selling, we're selling a little bit more now. A lot of properties I like to just hold, but we have a couple of situations where it makes sense to sell. Just because of the returns that we're going to achieve. And in one property, just as an example, won't go into a lot of details on it, but, we paid in the 40s a door for it, and it's going to be close to, mid 80s a door after a couple of years. But we have a situation there where the lender is requiring us to rebuild 4 units that burned down, and it's going to be $300,000 a unit to rebuild when we paid, in mid 40s a door. So from a financial standpoint, and we have an insurance claim on that, but from a financial standpoint, we feel that doesn't make a lot of sense. So that's one we're going to probably look at just getting out of, and it's going to be really actually a home run on that deal. But in a couple other deals, we're looking at getting some broker opinion of values. Pricing has not dropped off at all. And in fact, cap rates are probably, starting to compress a little bit further, which sounds odd to a lot of people, but I think they're going to continue to compress even more as more money runs to multifamily and out of retail, office space, hotels. And we've talked to a number of equity guys as well that, have kind of stated they don't plan on putting any money into some of those other asset classes for at least a couple of years. And that could change, but it means these guys that have a lot of money, family offices and such, they need to put their money somewhere to work. And that's where they're going to go. A lot of them will go into multifamily. It's fared really well over the COVID pandemic.
Nice. I wanted to back up just a little bit. You talked about people not using that time wisely. I couldn't agree more. People just, set out, and say, oh, I'm going to hold off. And then they're losing a feel on the market. I feel like, not staying in there, at least in some degree. What were, the guys that are successful now, including yourself, can you give a couple more examples of what you were doing then versus the people that were sitting out?
Yeah. One, we were talking to brokers a lot. Brokers actually during that time, they wanted to talk to you. Like I said, they had extra time. I don't want to say they were bored, but they definitely had extra time. But also they were really trying to get a handle on the market. So they were using us in some respects too, which is totally cool, about what we were seeing in the market. So, hey, Mark, you have 45 properties. What are you seeing in the markets and different markets? How are they reacting differently? So they were actually sending out surveys, and then they would send out kind of a weekly report. A lot of the brokers were. So a lot more interaction as far as physical talking. Face-to-face wasn't really going on that much during that time. But shortly, even during the middle of COVID, we started actually physically going to properties and touring them and making offers and things like that. We were also underwriting a bunch of deals. A lot of people are like, well, how's underwriting going to change? And we have some, kind of some rules of how we change some of the underwriting. But at the end of the day, nobody really knew what's going to happen, right? I mean, we still don't know, ultimately what will happen, but we know we have some really good data points now that helps us kind of provide better information than we had, 3-4 months ago. But we were still underwriting a bunch of deals, still talking to lenders, still talking to brokers. We were making offers. We were touring properties. A lot of people, I just heard the other day, Tamia, my wife, was saying that there's some people that she heard about that, they haven't even left their house since COVID, But that's what we were doing. It was basically business as usual. We had to make some exceptions on the due diligence. We still were able to do that and things like that, but it was more, masks and things like that. And maybe some tenants were like, hey,
right.
I don't want you coming in. But we were doing exactly the same things we were doing that we were before COVID.
You mentioned that you like to hold properties. Can you just explain that model a little bit in the syndication space? Because it seems like a lot of operators are going to hold, say, 5 to 7 years. Their whole plan is to exit. Is that when you say you like to hold? Do you mean 5 years and exit, or do you mean even longer than that?
Yeah, I would say. A lot of syndicators, I think, are getting out 2 to 3 years as the market's kind of appreciated, right?
Right.
The downside of that, I'm not saying anything wrong with that necessarily. The downside of that approach, just as a model, using it all the time, is that you typically leave a lot of money on the table. So people that sold 2 years ago are kind of kicking themselves, saying, "I wish I would have held longer." Right? And of course, real estate can go down, but it will go back up. It always has over time. So if you're going to look at properties like that and say, well, do I like the property? Physically, does it have the characteristics I like? Do I have cash flow, and have been able to do some sort of capital event? So let's say a refinance or a supplemental loan, which is kind of a second loan on the property. If I can do those things and return a fair bit of the capital to the investors and still hold it and still cash flow, I personally think it makes a lot of sense if you like the asset and the area and things like that. Versus just saying, hey, I'm just going to sell it.
Sure.
And you leave a lot of money there. If we're going to hold properties 20 years. I don't know. Probably not. But they're definitely properties we're holding over 5 years for sure. But that only really works in my mind if you're able to make that big kind of payday to the investors. If not, then I personally think you do owe it to your investors to sell the property.
Let's talk about the underwriting a little bit. You mentioned maybe some things that have changed, or people ask. I know I get asked that a lot as well. Well, what are you doing differently now? I'd love to know, buying this many properties, you're still very active in the market. What did change, or if anything, from the way you were underwriting, say, January, or we'll say December, versus now?
Yeah. So one of the changes we didn't have any choice over was more the lending changes that came up with the lender reserves and things like that, which has been revised a few times since COVID, and for the better for us. So, we didn't have a choice on that. But as a result of that, we were kind of structuring some deals differently and saying, let's say it was going to be, $400,000 we have to put into the lender day one. The lender says, give me $400,000. I'll hold it for you for, a year. If the property performs, I'll give it back to you. That's one example. So in some cases we were saying, okay, Mr. Seller, how about you put the $400,000 in, for us. So it kind of made, that's another option. We'll give you the price you want, but we're going to do this and things like that. So that was something we didn't have a choice over. The other one with rates, rates have continued to go down, frankly, although people didn't know it was going to happen. And we'll see, but it looks like they're going to, probably stay low for a while. At least all indicators say that, but I don't want to predict that. The other bigger one we had is around, if you want a bridge debt, we did a lot of bridge loans, a lot of big value add deals. It almost went away overnight for all practical purposes. So it did change the type of deals we were looking at. because we're actually doing another bridge loan right now, which actually is pretty decent terms on it. But for several months there, it really wasn't a very good option. So we stopped kind of looking at some of those big, huge value add deals. The other one we were doing is kind of spreading out the rehab longer. So if we thought we could do a rehab in 12 to 18 months, we'd probably split it out, to 24 or maybe a little bit longer because of COVID and things just taking longer to get through. You have to be careful about that a little bit, spreading it out too long. If you're getting money from the lender's gonna, they're gonna kind of force you to use those proceeds. So just be careful a little bit about that. The other big one we were doing was around the total income growth. Before, let's say we're gonna have money you put in the property, maybe $6,000 a door. Maybe we're the first, couple of years we were going to increase income because of that. Well, for a few months there, we were saying let's assume no income growth, even though we put $6,000 a door into the per unit. We were assuming no income growth in year one. We've come off that on a little bit because we do have a number of data points that have really shown that the properties have performed really well. Probably the biggest one and the biggest unknown is cap rate. So, we're like sitting there. I mean, in all fairness, do we, all these guys are making these predictions, things like that, and they're wrong 99% of the time, anyways. But logic would kind of tell you that cap rates would probably go down, and people say, well, why is that? And we kind of mentioned some of the reasons why, but we always assume they're going up. We use an escalator on an annual basis and assume it's going to go up. So that's the one we kind of struggle with really, really early in COVID. Do we have to make our escalator, if it was going to be, let's say, a 0.2 per year, which is a full point over 5 years, do we have to make that higher now? So we kind of played around with that a little bit. I think in all respects that, a lot of people are underwriting at the current market cap rate and or even decreasing it. We haven't gone there yet. As far as that model, I'm not saying it's wrong by any means, but I'm just saying we haven't done that yet. So that's probably the biggest caveat, but just keep in mind, for those that don't know, the cap rate has zero impact on your cash flow, like absolutely zero impact. It's only going to be impactful when you sell or refinance or do a supplemental loan. And also know that nobody in the world knows what cap rate's going to be a year from now. It's a guess.
Okay, well, on that note right there, we want your best guess on the next, 6 to 12 months. What does Mark foresee? Your crystal ball, what's it saying?
I think cap rates will go down. We're already seeing it right now. Even on the broker opinion of values we've gotten over the last couple of months, we're seeing a lot of traffic at the properties. We're seeing rents being increased on a number of properties that we own. So I think that will continue. I think the properties that all the properties we own, because I'll share this because I think it's important data. The areas we've had the most struggle with is one property that's in a rougher area in Dallas, and we were able, for a short period of time there, we were able to give evictions, right, notices. So it was about 12% of the units we gave eviction notices to, and the vast majority of them actually just left without us doing the eviction. So good to get them out, but then occupancy dropped pretty much overnight quite a bit, right? So not great. So those areas are going to struggle a little bit more. And then the other area, nothing to do with the properties per se, that struggled, we had 2 properties in Savannah, Georgia, and Savannah, Georgia was impacted earlier than a lot of other areas in the country because of the port of Savannah does so much with China. So we struggled a little bit more there. Now, none of the property, we haven't done forbearance or anything like that, and hopefully we never have to on any loan. We're fine from an overall perspective. But some of those areas that are a little bit rougher, the tenants will typically take more advantage of the situation. They just will. So I do think pricing is going to go up. I think cap rate's going to go down. I think more money is going to be coming to multifamily. I think there are actually less buyers right now. Just as a general statement, we're seeing less buyers in the marketplace. We're seeing a lot more loan assumptions. I would say well over half the deals that we're seeing are a loan assumption as an option anyways. And that's really because our prepayment penalties are so high on these deals. And just, from a perspective, we have one property, it's $8.5 million loan, and it's a $2.6 million prepayment penalty on that. So,
Wow.
that's a huge, huge thing, right? That's basically our equity. That's our whole
I
equity.
appreciate you. Yeah. Right. I appreciate you bringing all that to light. I mean, I think it's so relevant right now. And I wanted to ask you, from what all's happened right now, has this changed your, say, buying plan moving forward? Just like you're talking about maybe properties that were in some rougher areas or have been the ones to struggle, has this changed maybe the criteria that Think Multifamily is looking for moving forward?
Yeah, it's a good question for sure. We have a lot of data points now, which is good, right? And, this pandemic, you can argue, is unique in the way it happened, and in the industries that were impacted was also unique compared to any other recession, because places were actually shut down. You couldn't actually go places, right? So it's impacted us probably a little bit, me personally, around I don't want to buy in the rougher areas. And, we lived in the Class A property and we had crime there, like literally, right? So crime's not going to go away. But the areas where it's really,
Right.
you kind of know the areas. You get familiar with the market. So the ones that have the higher crime and people that, the bad debt is already higher as a general statement, those are the ones that are going to get higher and higher. Versus we literally have some property. We have one property with 16 months in a row, 0 bad debt. Now, for that to happen is pretty unusual. And we have 45 properties and we only have one property that's been 16 months in a row with no bad debt, right? Those type of properties typically are going to perform. Will the bad debt go up a little bit? We still have had, I don't even remember what it is, probably a few $100s in 12 months, like literally. So the ones that already have high bad debt will continue to have a high bad debt. The ones, when you look at like economic vacancy, people are familiar with that, also includes loss to lease. Loss to lease is like someone just paying below market. I'd much rather have somebody buy a property that has a huge loss to lease, meaning people are paying below what they should be paying, versus a property that it all goes in economic vacancy, but it's bad debt. Bad debt is worse, right? And then just be careful too. I mean, not to go into too much detail, but as far as when you're looking at the financials of it, be careful whether it's cash-based or accrual-based accounting on the trailing 12 profit and loss, because that's where people can get really, really screwed, frankly, by not paying attention to that. And bad debt can maybe not show up on the accrual base, and it will show up on the cash base. And you're talking potentially hundreds and hundreds of thousands of dollars difference in value of a property based on that.
Gene Trowbridge and Jonathan Ney, founding partners of the top syndication firm Trowbridge Law Group, LLP, have a legal team with over 50 years of combined experience in real estate syndication and the practice of real estate securities law. Over this time, Gene and his partners in several past firms and currently have helped clients raise close to $5 billion in offerings by empowering entrepreneurs to raise capital legally. To learn more about Trowbridge Law Group, LLP, visit their website at trowbridgelawgroup.com or follow them on Facebook, Instagram, or Twitter. Mark, how do you prepare for a downturn like this, or how has this changed the way you're preparing for future downturns?
Keep cash. No, I mean, your properties keep. So we've always done working capital, which is money that you just kind of have to have there to kind of like prepay vendors like that. We've always done contingencies. Well, I should say always. First couple of deals, I didn't. Frankly, the guy that we kind of learned from didn't either didn't know the stuff, didn't teach us, didn't care. I'm not sure which, but either way, I didn't talk about it. So you want to have working capital, you want to have contingency, and you want to have extra in that contingency. No one's going to sit there. I've never sat there on a property and go, man, I'm really kind of sad we have too much money sitting in the bank. But we've gone reverse the other way, where we're like, man, we're waiting on the lender for 5 months to reimburse us $375,000. I wish we would have had a little extra money sitting there so we can account for those things. Now, you can always return the capital if you want to, right? And if it makes sense to do that. But I would say without a doubt, keeping more cash than you think you need. Now, some of that's been helped, frankly, by the lender. The lender requiring, let's say, as an example, 12 months of interest,
Right.
reserves, things like that. So that does help because that gives you a full year of mortgage payments.
Do you have a way that you like to calculate that extra reserve or that emergency budget?
Yeah. So working capital, we do 1 full month. So basically it's 8.3%. And then the contingency above that, it depends a lot on whether we have the reserves with the lender. If we do, it gives a little bit of cushion there because you have a full year there. And then the other one would be, are you raising money for the CapEx, or is a lender giving you money for CapEx? If you're raising money for the CapEx, you can theoretically have less contingency. Okay, because if you're waiting on the lender, so the way it typically works for a lender is, hey, Mr. Lender, we've actually, spent all this money. Here are all the receipts and pictures. Please send us the money. And they sit there and twiddle their thumbs till they, and they ask you, 10 ridiculous questions. And then, 2-3 months later, you get reimbursed, So that's where, in that case, you're going to have more capital sitting there because you have to have a lot of the GCs require, 30% or 50% down before they start in some cases. So what do you do if you have a big CapEx project? The other one would be depending on how big the CapEx is. If you're doing a big CapEx project, you're probably going to have to assume it's going to go over budget a little bit. If you're doing one that is, pretty light value add deal, then you don't need to. So it's not the 8.33 for working capital is pretty much exact science for us. The contingency isn't an exact science, but we do look at several indicators about, are we going to have extra money raised? Are we going to have money from the lender come in? Where's the money coming from? And how big is the CapEx project?
Nice. Grateful for the explanations and going in depth, Mark. Just to take a pivot just a little bit here, I believe anybody that's as successful as you are in business and especially real estate have a high level of self-discipline. And I'd love to know, how did you gain such a high level of self-discipline?
I think probably my parents. Both my parents were really disciplined, hard workers. Yeah, Tammy. I think Tammy's. It's a love-hate with my wife Tamil for me because my discipline, like with eating and fitness and things like that too. But I think to some respects, it's kind of in you. It's easier for some people, and I really do believe that it's easier for some people to do things and to be more disciplined. But I do think there are a lot of things in your life you can do if you actually have a plan and you follow through, and don't be unrealistic about it. I've always had big goals, but I've also done a really poor job of putting my goals on paper. And I think that was probably more because of maybe my thought process that if I fail, right, I put it on a piece of paper, next year I look at it and I didn't make that goal. So that was a struggle I had to get through. But I do think, you have to give up other things. That's what it comes down to. So for me, like sometimes I'll get up, the other day I got up at 4:30. Some people get up at 4 o'clock. I don't like get up at 4 o'clock. Seems just too early, but the other day I got 4:30. Last days I'll get up, 5. And again, if people get up earlier than that, that's fine. But it's still fairly early. Go to the gym, all that stuff like that. So I'm giving up sleep, I'm giving up whatever it might be, TV. So if you really want something, not just wishing you had something, you're going to give something up to do it. And I'm okay doing that. I give up sweets. I give up, I don't drink coffee anyways, stuff like that. But I'll do that. And people are like, well, why? I don't really know why, frankly. I just feel better if I'm not eating a bunch of junk. And feel better with myself.
No doubt about it.
But I do think, frankly, I had it modeled for my parents. So like I said, my dad he was a firefighter. He'd be gone, 72 hours in some weeks. And then he would also be 30 to 40 hours a week at a lumber yard. So he was gone, 100 hours a week. And, I'm not saying that's not a great thing, frankly. That's a model I fell into from a workaholic standpoint that actually caused some issues for me. But I definitely saw it modeled. My mom worked her butt off. We had 7 kids. She made the meal. She did everything, right? So that discipline I saw modeled. Now, with that said, you can have something modeled and still not be disciplined, right? It's still a choice. But as far as overall, like the
Sure.
kids in our family growing up, they're all extremely hard workers. And were we just born that way? Probably not. I think we saw it modeled.
What are a couple of daily habits that you're disciplined to do that have helped you achieve success?
From a regular life perspective, I've been able to carve out more times where I pre-schedule things, which sounds like, well, that's obvious. Why wouldn't you do that? I never would pre-schedule. Phone to go off, 20 hours a day. It was like, and I just really did a poor job of doing that. Now I do pre-schedule, with a calendar and stuff like that. And again, people probably think, well, that's obvious, Mark. Why weren't you doing that? I don't know. I didn't do it before. I had people in, 6 different countries that would call me from IT business, and I would be, up 24 hours a day taking calls, So pre-scheduling things and living. And now, if I'm like eating as an example, I can tell you 100% of the time up until probably even a year ago, I pick up my phone. If I'm out with friends, I'm out with my wife, kids, it doesn't matter. Pick up the phone, take the call. Now I'm like, well, I'm eating, you know what I mean? Or I'm with family or with friends. Not really that important. I get back with them. I can tell you, you can ask anybody in the industry that works with us. They'll tell you I'm probably the most responsive person that they know, period. I'm not just saying that because I am. That's what I believe you should do. But I do give a little bit more time to, hey, it's probably not, urgent at the moment. It's okay to finish eating, whatever you're doing. So that's one. I think always being active in the marketplace, always looking, kind of following the same steps we've always been following. And then just taking care of myself from a physical standpoint. I didn't work out for 20 years now. I mean, I work out quite a bit, and but I love doing it. And I also follow, I eat six meals a day, stuff like that. So that has helped me just more physically. And then the time management piece has helped me more from a personal standpoint with family and to me and my wife and friends and things like that. And then being active all the time, no matter what, on the business side. And, I think we're good buyers as far as, buying properties, and we're selling another property right now. And I can guarantee any broker is going to say we're good sellers too. And, you don't have to, if your whole goal is to screw the other guy in this industry, that's a problem. And you're not going to go far in the industry if your whole goal is to screw somebody. So don't be a pushover, but be fair. Do what you say you're going to do. And, don't do things, don't change terms. I can tell you a number of times where I've had plenty of reasons not to do something I said I was going to do, but I still did it anyways. And that means a lot to people.
Love that. What would you, with all the experience that you have now, as many deals as you've done, I think you said 45 right now that you have under management, what would you have done different on that first syndication?
I would have raised more money for sure. I think we raised it was $1 million raise. I think we raised 25, maybe 50 extra. That was it. Not enough. So definitely would have raised more on that one. And, that deal went pretty smoothly, actually. So I would have liked to buy a bigger deal. It was 64 doors, which is still, not too bad for your first syndicated deal. I do wish it would have been a little bigger because the amount of work is the same for, 100 or 200 unit deal as it is for a 64 unit deal. And that does cause a little bit of an issue because, we still kind of need a full-time manager there, but it's kind of too small for a full-time manager. So your payroll cost ends up being higher on a property like that. So still values, gone up a lot on that deal. So I don't really have any regrets doing that deal. But if we got a little bit bigger and would have raised a little bit more money for the CapEx and things like that, for the what ifs, those are the main things.
What's a way you've recently improved your business that we could apply to our business?
I think probably using more data, frankly. More data points. Now I think data is just data, but we kind of really do a good job getting local expertise because you just certain things you just cannot get out of data. So having someone that actually knows an area has helped us either go there more or not go there at all. And then that's probably the main thing, I guess, using more data.
What's your best source for meeting new investors right now?
If you give free content, so we have a podcast too. We definitely get a lot of leads from there. But we have found doing webinars, free webinars, right? we get a lot of traction off those. I mean, a lot. And we have one coming up here too. And we surprisingly have gotten more traction than I would think off of that. And then, if you're kind of newer to the industry, I would say try to get on other people's podcasts. Most people are looking to get people on their podcast. So I'll get leads, for sure every week from somebody else's podcast. There's one podcast we did where we've gotten, like, I'm not even joking, probably over 400 leads off it, which is a lot.
Wow.
A lot off a podcast. It kind of, outshines all the other ones, but it's, if we were never on that, we would have 400 less leads. So crazy.
Wow. Yeah. What's the number one thing that's contributed to your success?
I think grit, not giving up. A lot of things I could have given up on. And in fact, multifamily syndication, both Tamil and I almost gave up on. It took us a year to get our first syndication, and we were right on the verge of giving up on it. So just if you have a big enough why, and I did at that time, it wasn't really money. I was making good money in the IT business. It was really more family and things like that, marriage. If you have a big enough why and you just don't give up. It's in every aspect of it. I get frustrated just like everyone else in a lot of different areas of my life, but it doesn't typically discourage me.
How do you like to give back?
So from, we do have an educational platform, which we like sharing. We share a lot more things, in my opinion, kind of good, bad, ugly, than maybe a lot of other people do out there. And then as far as from, we were both, Tamil and I, are passionate about sex trafficking industry, which, thankfully is getting a lot more press recently. So kudos to the people that are actually making a real big effort on that. We have a couple industries that we support, that orphanages as well, one in Nigeria and then one in Philippines. Our friend started the one in the Philippines, and the one in Nigeria we've been involved with about 15 years. So basically giving back. And, frankly, I never knew how I personally would feel if I started making more money, because I was always fearful of money in my entire life pretty much. But we've been able to give a lot more than I ever thought we probably would be able to. And literally it is changing people's lives. It really is. So you find something you're passionate about. For us, it's sex traffic industry and the orphanages.
Mark, incredible show. Always grateful to connect with you and see you at different conferences and different places we've been, and just see your business growing. Like I said, I've had many people on the show who have contributed their growth from your platform. So grateful for your time and just sharing what you're doing. Now you've went into 7 different states. You got 4 more deals under contract amongst the 45 you already have right now, and how your underwriting has changed, what you feel like is happening in the market, and just your buying plan moving forward. You've shared so many insights I'm grateful for. Tell the listeners how they can get in touch with you and learn more about you.
Yeah, best via email. It's Mark, M-A-R-K, at thinkmultifamily.com.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.